concept assembly line, where ideas get to work. Every so often, American drivers feel the weight of global instability press against their wallets, not through headlines, but at the pump. In June 2025, as military exchanges escalate between Israel and Iran, gas prices in the US are quietly ticking upward. No embargo was declared. No tankers were sunk yet, but traders didn't need an oil shock crisis to unfold in full to start hedging against it. This is how oil markets work, not by pricing what's happening, but by guessing what might. Gas prices don't just reflect today's supply and demand. They are a story of expectations, speculation, and the tangle of international supply chains that support America's uniquely complex gasoline market. Understanding why gas is expensive in the world's current largest oil producer means understanding oil not just as a physical substance, but as a financial product traded in a market that few consumers ever see, yet all are subject to. Commodity markets have always been about managing risk. In the early 19th century, Midwestern grain merchants in Chicago began striking forward contracts, agreements to buy crops at a fixed price, delivered later. These informal deals evolved into futures markets, standardized, regulated exchanges where traders could hedge risk by locking in prices ahead of delivery. Oil, wheat, copper, pork bellies, natural gas. Each of these goods now trades as both a physical product and a financial instrument. Futures markets allow producers to stabilize revenue and consumers to anticipate costs. But they also create space for speculation, where hedge funds and institutional investors make bets untethered from the underlying need for the commodity itself. In oil markets, this speculation can ripple quickly into consumer prices. When conflict breaks out near shipping lanes in the Strait of Hormuz or sabers rattle in the Middle East, traders bid up the price of crude oil futures in anticipation of possible disruption. Even if the supply shock never materializes, the pricing signal has already traveled through the financial markets into gasoline wholesalers, refiners, and, eventually, the local gas station sign. Despite its global nature, oil pricing plays out with very local consequences. The US is the world's largest effective oil producer, but that doesn't mean it has cheap gas. Why? Because oil is not one thing. It varies in weight, sulfur content, and ease of refinement. American shale production is dominated by light sweet crude, the kind that's easier to extract and cleaner to burn. But US refining capacity was mostly built in an earlier era, when the country relied heavily on heavy sour crude imported from Venezuela, Mexico, and Canada. This creates a structural mismatch. The US produces lots of oil, but much of it isn't ideal for domestic refining. Instead, it gets exported. Meanwhile, we continue to import the heavier crude our refineries are designed to handle, especially from Canadian tar sands. This isn't just inefficient, it's fragile, because when the geopolitics of heavy crude shift, so does our ability to make gas. The complexity doesn't stop there. Refining itself is a bottleneck. The US hasn't built a major new refinery in nearly 50 years. Maintenance, accidents, and weather can all take refineries offline, creating regional shortages even when global supply is stable. For example, a Gulf Coast hurricane can spike Midwest gas prices without disrupting global oil supply at all, because the refineries themselves are the choke point. And while Brent crude, the international oil benchmark, reflects global prices, US gasoline consumers are ultimately tied to a domestic supply chain that's heavily exposed to local refinery capacity, pipeline logistics, and the structure of gasoline blending rules that vary by state and season. For the last decade, US shale has powered America's ascent to the top of global oil production charts. But that era is showing signs of exhaustion. Industry analysts now suggest that the US has likely hit peak shale, not because the oil is gone, but because the economics no longer make sense. Shale wells deplete rapidly, often producing up to 70% of their total yield in the first year, then quickly tapering off. To maintain output, companies must constantly drill new wells. But that process is expensive, labor-intensive, and increasingly uneconomical unless oil prices stay well above $70, $80 per barrel. That price floor makes US production fragile. If prices drop too low, even temporarily, investment dries up. Shale isn't a reservoir, it's a treadmill, and many producers are nearing the limits of cost-effective acreage. Unlike conventional oil fields, shale doesn't reward patience once the sweet spots are gone. The marginal wells produce less and cost more. This is where geopolitics enters the chat. While the US may currently lead in total production, it doesn't control the floor. OPEC, and particularly Saudi Arabia, still possesses vast reserves of cheap, easy-to-extract oil and spare capacity to pump more if it chooses. Right now, OPEC is intentionally limiting production to keep prices stable and profitable. But if it ever chose to flood the market with supply, whether for strategic, political, or economic reasons, it could collapse the global price of oil well below the break-even point for most US shale producers. Such a move wouldn't just undercut US producers, it would threaten to bankrupt them. In that scenario, America's brief window as the dominant oil producer would close, not because of resource depletion, but because of market dynamics it does not control. The US is not the largest potential oil producer, it is the largest current producer. And that status can change with a shift in Saudi pricing strategy or Russian sanctions policy. The strategic risk is clear. The US is doubling down on gasoline dependency, weakening fuel efficiency standards, obstructing EV deployment, and favoring fossil fuels in public investment at the very moment its oil advantage may be peaking. And because US refining is still heavily dependent on heavy crude imports, any disruption, whether from geopolitical instability, new sanctions, or border tariffs, creates asymmetric pressure. The US may be energy abundant, but it is not energy autonomous. This makes tariff policy particularly consequential. When the US imposes border tariffs or faces retaliatory export restrictions from heavy crude exporters like Mexico or Venezuela, it directly impacts the feedstock required to make American gasoline. Ironically, the nation with the current largest oil output in the world remains vulnerable to supply chain disruptions it can't refine its way out of. In a globally traded commodity market, this is like going all in on a currency you don't control. Unlike the dollar, oil is not a sovereign tool. Its price is set by a messy tangle of physical supply, futures speculation, cartel decisions, and geopolitical disruptions. To depend on cheap gasoline is to tether domestic stability to a market the US can't reliably steer. Rather than hedging that risk by expanding alternatives, public transit, EV access, domestic battery production, or even hybrid fuel efficiency, the current administration is choosing to amplify it. In a world where gas supply is vulnerable to global events, weakening domestic demand-side policies amounts to doubling down on volatility. Reducing the average fuel economy of US vehicles increases total gasoline demand. That makes Americans more exposed to international shocks, not less. The paradox is stark. The more the US reverts to gas dependence in its transportation sector, the more fragile its energy economy becomes. Rather than investing in insulation from volatility through EV deployment and transit alternatives, current federal policy has leaned into the most vulnerable parts of the petroleum system, both economically and geopolitically. Commodities markets exist to help us manage risk. but they can't protect us from bad bets. The volatility of oil prices in response to Middle East tensions isn't just about geopolitics, it's about exposure. America's gasoline prices are the sum of outdated refinery infrastructure, mismatched crude inputs, brittle shale economics, cartel leverage, and weakening policy foresight. The futures market isn't forecasting doom. It's reflecting our refusal to prepare for it. US oil dominance is not guaranteed. It's conditional, expensive, and increasingly vulnerable. We can treat that as a temporary advantage to invest in resilience, or as a mirage to build policy around. The longer we build on the mirage, the more painful it becomes when it vanishes. This video is part of a broader project to reimagine public policy for real people. Grounded in modern monetary theory, committed to abundance over austerity, and focused on rebuilding the freedom infrastructure of everyday life. If my work resonates with you, share it. Subscribe on YouTube for more multi-format content. Together, we can reclaim what was once built and build it back better.